Joining us for more on the markets, Tom Hainlin, National Investment Strategist at U.S. Bank Asset Management. Good morning to you, sir.
Good morning, Leslie.
I'm curious as we think about just the last few trading days of the year and going into next year. We're doing so at fairly lofty valuations. The market's seen decent appreciation this year. Is that a concern of yours as you think about your portfolio heading into the new year?
Leslie, I think what was confidence building was that the market hit an all-time high on Christmas Eve, but it wasn't tech that hit all-time highs. It was actually industrials and financials. And so seeing that broadening out across the sectors, especially those cyclical sectors, I think gives us a little more confidence heading into the next year. You've also seen strong performance, really down cap in mid and small cap stocks. So it's not just tech leading the way now. You've got those cyclical sectors, those smaller companies also participating. I think that's a helpful setup into the new year.
You also note that the consumer remains the anchor to U.S. growth, and that's expected to continue next year thanks to rate cuts and tax benefits from the plan passed earlier in the year. How concerned are you about the labor market kind of pouring cold water on that?
That's the linchpin, right? So, consumers are spending money that they earn, so they both have to earn the money and then the confidence to go ahead and spend that. So we're looking for layoffs. That's kind of a particular area of focus. As long as those stay relatively subdued, we think that's a positive setup for the consumer to continue to have another good year in 26, which is really the linchpin of the economy. And the other is just then businesses investing the money that they're earning into capital equipment and AI and everything else that's really driving the economy.
I was going to say that's obviously been a key area of growth as well. It's just the AI economy, how much has gone into CapEx there. Do you expect that to continue in a big way, or do you think we could see some changes on that front, just given the size of the investment this year and whether the market will still be open for it next?
Yeah, we haven't really seen any changes in kind of the investment levels in AI and other productivity tools. And those benefits are not just flowing to the kind of the picks and the shovels of the AI industry, but the companies that are employing that to help drive growth and productivity and maintain those profit margins. So we see continued investment in AI, robotics, other CapEx in the technology sector, again, just really driving that productivity again into 2026.
And then in terms of the top opportunities you see, it's in income and foreign equities. Where specifically within those two buckets do you think are key opportunities next year?
For bond market investors, you're starting with pretty good yields, but there's additional opportunities for example, in the mortgage market, those mortgages that aren't backed by federal agencies to kind of capture that additional income on the back of that healthy consumer and homeowner. And then foreign equities, both Europe and Asia, we see opportunities. Valuations aren't the same that they are here in the United States, and you have kind of positive monetary and fiscal policies supporting growth. And then you also get that capture of additional dividend yield. And those cash flows tend to go into share buybacks, which again support price appreciation.
Hey, Tom, just real quick, how do you play that foreign equity story? Is it a broad-based mutual fund that one buys? I mean, you could also buy U.S. multinationals as well in terms of capturing foreign growth.
It's a good question, Steve. We prefer kind of broad allocations and capturing also not just those multinationals, but those local champions, whether it's in Europe and Asia. So you've got the fiscal stimulus within Europe, you want to own those local companies there. And then Asia's embarking also on AI investment. Again, some of those companies aren't listed globally. There aren't U.S. multinationals. So both, Steve, both the multinationals, but also those local champions, and allocating that towards more of a broad approach.